Your bank is robbing you, legally. Right now, they're paying you 0.46% on your savings. That's the national average. Meanwhile, they're taking that same money and lending it out at 7, 15, or 24% interest. You are the product, not the customer. And the worst part? There are ways to stop this from happening. None of them complicated. Some of them take 10 minutes to set up, and almost nobody talks about them. That's what this video is about. No fluff, no track every receipt and clip coupons nonsense. Just real moves with real numbers that flip you from the person being used to the person collecting. In this video, I will show you 7 easy ways to escape the bank trap and make your money work harder than you do. Let's get into it. Here's the situation as of right now. The average traditional savings account in the U.S. pays 0.46% APY. That's the national average according to the FDIC. Meanwhile, inflation has been running between 3 and 4% in recent years. So, in real terms, your safe savings account is losing you money every single year. It just doesn't look like it, because the number on your screen goes up a tiny bit every month. This is the bank trap. Your money feels safe, but it's technically not. So what do? You have 7 options. And unlike what most people think, you don't need to be rich to do any of them. You need to be informed. Stay with me and let's break it down. Way number 1, high-yield savings accounts. The easiest move with zero risk and zero learning curve. Right now, you can find accounts paying between 4.5 and 5.25% APY. That's 10 times the national average. On $10,000, that's $450 to $525 per year for literally doing nothing differently. Where to find them? The best rates right now are typically at online banks. SoFi, Marcus by Goldman Sachs, Ally, and Lending Club Bank consistently show up at the top. I'd recommend checking NerdWallet's AHYSA comparison tool or Bankrate. They update rates in real time so you can make the best decisions. The catch? None, really. These accounts are FDIC insured up to $250,000. Funds are accessible. The only downside is you won't get rich from this alone. But it's the foundation. Your emergency fund and your short-term savings? Move it to a high-yield savings account today. Believe me, you won't regret it. Way number 2, Treasury bills and I-bonds. Step up in yield, still zero risk. Treasury bills, T-bills, are short-term government securities that have been yielding between around 3.5% recently, depending on the duration. 3 months, 6 months, 1 year. You loan money to the U.S. government, and they pay you back with interest. The government has literally never defaulted. This is as safe as it gets. Here's what most people don't know. You can buy them directly at treasurydirect.gov with zero broker fees. No middleman, no commissions, and the minimum purchase is only $100. Now, I-bonds are a related product but slightly different. They're indexed to inflation, so their rate adjusts every 6 months. When inflation is high, they can be extraordinary. A couple years ago, they hit 9.62%. Today, they're lower, around 4 or 5%, but they're still worth understanding, especially for money you won't need for at least a year, because there's a 1-year lockup. Way number 3, money market funds. This is something that even financially literate people underuse. Money market funds are not the same as money market accounts at your bank. That's a common confusion, and banks love it. A money market fund is an investment offered through a brokerage that holds short-term, ultra-safe assets, government securities, or corporate papers. Right now, funds like Fidelity's SPAXX or Vanguard's VMFXX are paying around 4.9 to 5.1%. And unlike a savings account, that yield often updates daily. Your money stays liquid. You can move it in or out within a business day. And you earn while it sits there waiting for your next investment. If you already have a brokerage account and you're keeping cash there doing nothing, or if your cash is sitting in your bank account between investments, a money market fund is a no-brainer upgrade. Way number 4, dividend investing. Now we're getting into the part that actually changes your financial trajectory over time. Dividend investing is owning stocks in companies that pay you a portion of their profits, regularly, every quarter, just for holding shares. You become a part owner of a business. The business makes money. You get a cut and you don't have to do anything except hold. Some of the most reliable dividend payers are called dividend aristocrats, companies that have increased their dividend every single year for at least 25 consecutive years. Think Johnson & Johnson, Coca-Cola, Procter & Gamble. These aren't flashy. They're not going viral. But they've been quietly writing checks to shareholders through recessions, pandemics, and market crashes without missing a beat. Now here's where it gets powerful. Dividend reinvestment. You take those dividend payments and buy more shares automatically. Those shares pay more dividends. You buy more shares. This is compounding working in your favor instead of against you, which is exactly how banks have been using your money all along. A solid starting point for research, Dividend.com tracks aristocrats, yield percentages, and payment histories. Seeking Alpha goes deep on fundamental analysis and is also a great tool. If you want pure simplicity, ETFs like SCHD, that's the Schwab US Dividend Equity ETF, or VYM from Vanguard, give you a basket of dividend payers without having to pick individual stocks. Way number 5, index fund investing. I want to talk about something Warren Buffett has literally said in writing in his annual letters to Berkshire shareholders. For most people, a low-cost index fund is the single best investment available. Here's why this matters. The S&P 500, which tracks the 500 largest companies in the U.S., has averaged roughly 10% returns per year over the last century. Not every year. Some years it's up 28%. Some years it crashes 30%. But the average over time is about 10%. If you invest $500 per month into a low-cost S&P 500 index fund starting at age 25 and do nothing else, no stock picking, no timing the market, you could have somewhere in the range of $1.5 to $2 million by age 60. That's not a guarantee, but it's historical math. The key word is low cost. Look for funds with an expense ratio below 0.1%. VOO from Vanguard, SPY from State Street, and IVV from iShares are the 3 most traded in this category, all under 0.1% expense ratio and all tracking the same index. If you aren't too big on online resources, let me point you to a book. The Little Book of Common Sense Investing by John Bogle, the founder of Vanguard. It's the most important book on index investing ever written, and you can get it for $15. Way number 6, real estate investing without buying property. Real estate, and most people immediately think, I need a down payment, I need a mortgage, I need to deal with tenants, I need 200 grand to get started. Well, wrong. You can own real estate right now with as little as $10. There are 2 ways to do it. Real estate investment trusts. These are companies that own income-producing real estate, apartment complexes, shopping centers, data centers, hospitals, and they're required by law to distribute at least 90% of their taxable income to shareholders as dividends. You buy shares like a stock, and then you collect the rental income. It's that simple. VNQ from Vanguard is the most popular REIT ETF. And then there's Realty Income. It's famous for paying dividends monthly, not quarterly. It's nicknamed the Monthly Dividend Company and has paid for decades without interruption. The second option, real estate crowdfunding platforms. Fundrise and Arrived are the 2 I'd steer you toward if you want to invest in actual properties with a small amount of capital. Fundrise starts at $10. Arrived lets you invest in single-family rental homes starting at $100. You own a fractional share. They handle everything and collect the rent. Neither of these is a get-rich-quick scheme. They're a way to get exposure to real estate returns, historically around 8 to 12% annually, without the massive entry barrier. Way number 7, build one income stream that runs without you. This last one is different from the others. It's not about investing dollars, it's about investing time once to get paid repeatedly. Every wealthy person I've studied has at least one thing in common. They have income that doesn't require them to show up. That's the real definition of financial freedom. Not a number in a bank account, but a system that generates money whether you're working, sleeping, or on vacation. So here's the honest truth about passive income. It's never truly passive at the start. You have to build something first. But once built, the ratio flips. What does that look like practically? Try digital products, an ebook, a template, or a course. You create it once, you sell it forever. Platforms like Gumroad or Payhip let you sell digital products with 0 upfront cost and minimal technical skills. You need content that compounds, Every piece of content you create becomes a permanent asset. That's compounding, applied to attention instead of money. Peer-to-peer lending platforms like Prosper or Lending Club let you be the bank, lending money to individuals and earning interest income. Returns can range from 4 to 8%, depending on the risk profile of the loans you choose. Yes, there's risk. But now you're on the right side of the interest equation. Licensing intellectual property is also a great option. If you have a skill, photography, music, writing, software, platforms like Shutterstock, Audio Jungle, or GitHub sponsors will pay you every time someone uses your work. The key idea across all of these is that your first job is to become an asset creator, not just a wage earner. Wages stop when you stop. Assets don't. So here's the recap, your 7 ways to escape the bank trap. 1. High-yield savings accounts. Earn 10 times your current bank rate, 0 risk. 2. Treasury bills and I-bonds. Lend to the government, earn 4 to 5%, no fees. 3. Money market funds. Liquid, high-yield parking for your cash. 4. Dividend investing. Get paid to own companies, reinvest, compound. 5. Index funds. Set it, forget it. Let the market work for you over decades. 6. REITs and real estate crowdfunding. Real estate returns without the landlord headaches. 7. Build one income stream that runs without you, because trading time for money has a ceiling. You don't have to do all 7. Pick one. Start this week. Even moving your emergency fund to a high-yield savings account this afternoon puts more money in your pocket than doing nothing. The bank has been using your money to get rich since the day you opened your first account. Now, you know how to flip that. I'm leaving the links to all the websites and resources I mentioned in this video in the description. Which of these 7 are you starting with? Let me know in the comments below. If this gave you something real, not just motivation but actual moves, drop a like and hit subscribe. Every video I make is built around this same premise. Real information, no fluff, no upsells. Just the stuff that actually works and helps people like you.